Good morning, everyone. Thank you very much for joining me this morning. This is the morning market review. My name is Russ for Senior Market Specialist at FXCM. My email address r@fxcm.com, and today is Thursday, it's the 5th of May, 2022. Just going to bring up our high risk investment warning. Keep this on screen for a few moments, then I'll show the commentaries disclaimer. Hey, Sedesta, good morning to you. Nice to have you on the webinar. Hey, Howard. Good morning to you. Thank you, everyone, for joining this morning. Let's just bring up our market commentaries disclaimer. Okay, and our references. So we'll be looking obviously at MarketScope 2.0. I'm going to start off just getting the CNBC information, and then we'll take potentially a look at TradingView as well. Let's just bring up a chart. So here's the DAX. But before we get into any sort of analysis, let's go through the CNBC. Pete's asking, is the 50 basis point rise going to do anything? All right, let's start off with the headlines, and let's see if we can make some sort of sense out of what happened with the Fed yesterday evening, and see if we can make any sort of inferences in terms of our positions. So the CNBC article starts off the headline is European markets set to jump after Fed quashes hawkish bets. Okay. European markets are set to climb on Thursday, tracking global sentiment after the US Federal Reserve doused speculation about more aggressive monetary tightening. The Fed on Wednesday raised its benchmark interest rate by 0.5 percentage point, its biggest hike in 2 decades, as it looks to rein in inflation running at 40-year highs. The central bank will also begin reducing its balance sheet in June. However, Chairman Jerome Powell ruled out more aggressive hikes in future policy meetings, prompting a relief rally on Wall Street as traders began backing the Fed to contain inflation without causing a recession. US stock futures were muted in early pre-market trade on Thursday after the Dow surged more than 900 points during Wednesday's regular trading session. Shares in Asia Pacific also advanced during Thursday trade following the Fed decision, with mainland Chinese stock leading gains on their return to trade following several days of holidays. Focus in Europe today will return to the Bank of England, which is expected to announce a 4th consecutive interest rate hike to combat soaring prices. The war in Ukraine also remains on investors' radar. Russian forces have reportedly renewed their air assault on the Azovstal steelworks complex, the last stronghold for Ukrainian fighters in the southern port city of Mariupol. Meanwhile, the EU has proposed a gradual ban on Russian oil in its 6th round of sanctions against Moscow since the unprovoked invasion of Ukraine. Corporate earnings continue to guide individual share price action in Europe. We'll see Shell, which actually has released already, it's got its highest quarterly profit since 2008. BMW, Leonardo, Unicredit, Banco BPM, Societe Generale, and a whole host of others. All right, 50 basis points. Just want to go back to CNBC for a moment. And I just want to see if I can get some quotes from Jerome Powell, but he effectively started off the press conference addressing the American people, so kind of appealed to the on a personal level. The key here, and I think it links to Pete's question, is Fed Chairman Jerome Powell underlined the commitment to bringing inflation down, but indicated that raising by 75 basis points at a time is not something the committee is actively considering. Okay, so that's I think that's a key point there. Inflation is much too high, and we understand the hardship it is causing. We're moving expeditiously to bring it down. So it was an unusual direct address to the American people. We strongly committed to restoring price stability. This likely means, according to the chairman's comments, multiple 50 basis point hikes ahead. So I'm trying to kind of trying to vocalize my thoughts. I actually think that was a tactical mistake. I think it was a tactical error by the Fed. They've kind of they're treading on dangerous ground here because I think they're still very far behind where they need to be, and inflation is still way too high. By closing off the possibility of higher rate hikes, I don't think that's a wise move. You can still move 50 basis points, but having the market on edge for a 75 basis point hike is probably a fairly good thing in terms of trying to control expectations. The whole point about an inflationary spiral is you've got to stop the expectations from spiraling. That's the whole key. So moving from a very hawkish type of perceived stance to a much more dovish perceived stance in the face of inflation that's running at rates that we haven't seen since the early 80s. It seems to be a schoolboy error to me. excuse the phrase, but it's just something that perhaps I don't think needed to necessarily be communicated. If we go to through to the US dollar, what effectively so let's call it the dovish tilt is likely to do, I think it's probably likely to clear this RSI. So this RSI being in excess, being overbought, has been bothering. How is it going to clear? How is it going to clear in the face of such hawkish pressure? And it almost seems as if the Fed has sort of opened the door for that. And I think that we get some sort of normalization in the RSI. That means we've probably hit some sort of ceiling in the near term. Probably, I mean, nobody knows for certain, right? This is you kind of interpret the information and make inferences, hoping that your assumptions are as close to reality as possible. It all depends on the assumptions, how accurate the assumptions are. So the idea here is the dollar is probably overbought at the moment. Why would it be overbought? Is because everybody piled into the greenback on the back of hawkish rhetoric by the Fed, and the Fed is now walking back on that hawkish rhetoric. That probably suggests that there is a fair reason to start taking some profits here. It's probably a fair reason to start banking some profits. Thinking, look, everything that we expected has fully been discounted. Now there's probably an excess in terms of that discounting. Markets are efficient, information is inefficient. It's probably going to see some sort of alleviation here, I would expect, and some sort of normalization of the RSI. So that's kind of what I think would happen. Whether it happens or not, we're going to have to go down and look at a lower chart to see that in terms of the timing, right? In other words, the point is, okay, the weekly chart is overbought, but weekly chart access is very poor for timing purposes. So if we go down to, say, the daily chart here, well, here you can see that the excess is starting to clear already. Okay, so here it's dropping, it's pushed into the daily was also overbought. The daily froth has started to dissipate. It's just a matter of when does the weekly, okay, start to dissipate. It doesn't spend all that much time. So going back to 2014, here it's into a fair amount of time here being overbought, but it's quite unusual. So we'll just have to keep an eye on the froth on weekly. The daily chart has already started to clear. Okay, so there's already been some sort of profit taking, and that's because the Fed has dialed back on its hawkishness. Okay, it's trying to me it's pointing more and more to a credibility issue. So when the pandemic hit and they came out with unlimited QE, that was a good move, okay? But then the QE, in hindsight, okay, in hindsight's 2020, the pandemic was obviously a very difficult time to manage. In hindsight, they kept the money best running for too long. Okay? That, with expansionary fiscal policy, resulted in a tremendous amount of inflation. So there was a byproduct to not managing that correctly in hindsight, and that byproduct was high inflation. Okay, then the tightening in hindsight perhaps could have been done earlier. In hindsight, perhaps could have been done earlier. But the Fed was always calling that inflation transitory, until it turned out to be sustained inflation. And the market was suggesting sustained inflation. The Fed sort of hanging onto that transitory right to the last moment, and it was only retired at the end of November last year. And now, when there is this huge rate of change in terms of inflation, and you have effectively now pushed the market into a position where it probably is susceptible to cutting back on spending to some degree, starting to take some notice. That's when you decide to walk back on your hawkish rhetoric, your hawkish rhetoric. Again, seems crazy, seems like a schoolboy error. Anyways, we'll have to see how this plays out. So they've effectively taken their foot off the hawkish accelerator. And I think that's a mistake, and I think they're going to have to re-accelerate because they're very far behind the market, unless the market yields start moderating. So that's the other option. Perhaps they correct, and the market yields start moderating, but we'll see. Base, all right. What happened to the Nasdaq? Because KD sent an email. He won't be able to join us today, but he said if you can just go through the Nasdaq. Why did the Nasdaq rally off of the base of a 50 basis point high? It's because the market was overcommitted to the hawkish rhetoric. In other words, the fact that it was dialed back. The market's perfectly efficient. Information is inefficient, right? So it had baked in huge amounts of hawkishness only for the Fed to take its foot off the accelerator. Well, then the market has no choice but to move up. There's no choice but to move up because it's overcooked at that particular point in time. All right. So to me, a very odd message sent by the Fed. So I'm trying to understand why would the Fed do that, and there actually may be some wisdom in what they're doing. I'm not sure. There may be some wisdom. So how would we say, well, yes, the Fed is actually doing the only thing it can? well, then we have to look at our economic demand and supply. Okay? And we've got to understand that we've got two opposing forces in the economy. We've got the supply side and we've got the demand side. Okay, the demand side is this downward sloping. We're just going to call it D for demand. It's actually AD, aggregate demand. And then we've got supply. Now, what's happened with the oil market, the natural gas market, is that it's affecting the supply side. It's, think about it, your raw materials for production. Your raw materials for production are increasing. So that's affecting supply. So your supply side gets pushed back. And I'll just make that. Now, the result of that, okay, is you can see that the intersection has moved up. Okay, the intersection has moved up. And what that intersection is, okay, the y axis is, just think about it, inflation. So the idea here is that the supply dynamics is a large cause. It's a large cause of the effect of high inflation. Okay, the Fed can do nothing about that. It can do very little. When I say nothing, it can do very little about supply side inflation. Supply side inflation has a name to it. It's called cost push inflation. Okay? You can Google it, cost push inflation. That's the supply side. Fed and monetary policy can do very little with cost push inflation. In fact, if the Fed acts, it's acting on the demand side. Okay, so let's just say that the Fed is now going to move demand. Okay, so it wants to move demand, and the way it's going to move demand is that it can either move demand up or it can move it down, depending on whether it's expanding monetary policy or contracting monetary policy. Well, clearly, in this case, it's going to be looking at a contraction in monetary policy. So a contraction shifts demand to the left. Okay, that's the economic theory. I'm going to just make this blue. All right. That looks really, really good. And let's make this D1. Now, take a look what the contraction does here. It puts our inflation rate right back at where it was in the beginning. So it seems at first we're back here. That's terrific. So all of a sudden the Fed's done a great job in controlling inflation, but we've ignored the x-axis. We've ignored the x-axis, and for the sake of this conversation, we're just going to call this employment. We'll just call it employment. Okay, it's more than employment. It's gross domestic product. But for the sake of this conversation, we'll call it employment. So look what the Fed has done. It's moved employment down. So yes, it's controlled inflation, but at a cost. What's that cost? Rising joblessness. Okay, that's what active monetary policy does in a stagflationary environment, in a cost push environment. So by maybe dialing back on that hawkish expectations, perhaps they taking into account this part of the economy. And that's strange. That seems a bit odd to me, because the interest rate, the U3 defined, a big one, U3 defined unemployment rate is 3.5%. It's very strong. It's very strong. So if you're going to try and attack inflation head on, it's probably better to do it when you've got a tight labor market than when you've got a loose labor market. Okay, so they kind of in a window of opportunity here to maybe try and minimize the destruction of a contractionary policy. And to me, it seems they've almost sort of shot themselves in the foot by taking that off the table. Again, I'm going to say subject to correction. Okay? Subject to correction. In other words, what the Fed may be doing is they may be just not really wanting to influence the market as much as extreme hawkishness would suggest, and they would want the market forces to institute some sort of self-correction. Okay, which is probably the best thing to do. But the idea here is, I think that the Fed has inadvertently crippled itself to a small degree. So we just want to keep an eye on that, because inflation is still an issue. We're going to have to keep an eye on that. And then let's take a look at trading view now. Just want to bring up trading view. All right, so let's just take a look at US 10-year, and then I'm going to just move on to some more discussion about inflation. And after all of that, I'm going to come back to just chart analysis. But the idea here is with the US 10-year, we can add in, of course, the RSI. All right, and you can see that the RSI has moved into overbought. So maybe this sort of dialing back again causes some sort of bounce in the bond market, yields come down. But then, just like the dollar, I would look for this as a potential dip in an uptrend, because the contractionary monetary policy is still very much a variable we have to deal with. So any sort of pullbacks now, is probably an opportunity for us to look for dips, to buy the dips. Let's just go through to the core US. Let's see if I can get this US core PPE. That's it. PPR. Okay, good. That's the one. Okay, so this is core producer price index. This is been up. All right, and it's still running hot. You can see, look at the producer price index has accelerated tremendously. Let's take that out, and then let's try and overlay that with consumer price index, which the consumer price index would be more akin to what the monetary policy tends to look at. All right, so it's quite the right chart. Nevertheless, all right, so it's the producer price index that has been pulling the consumer price index. But these quite the right charts. I'll take a look at these going for tomorrow. But the idea is until the PPI comes under control, which is out of control of the Fed and policymakers in general, it's going to have an effect on CPI. You can see that's how the PPI has been pulling CPI up. All right, having said all of that, let's take a look at some of our charts and see what are the potential opportunities for us. And we'll start off with the DAX here, and we'll do a top-down analysis. And the analysis is very interesting at this point. Okay, let's take these off here. It's a higher trough, which again would be quite surprising to me, but nevertheless, it looks as something that we've certainly got to keep an eye on. So let's okay, so what we would do is we would be looking for something like this: 1, 2, 2, 3, 1, 2. Now that would be a higher trough followed by a higher peak. That's actually putting DAX back into uptrend. Now, whether that happens or not, I don't know. I have my doubts because I'm of the opinion that the only reason we're getting this big push up here is because of this communication by the Fed. And I think the Fed, as I say, just crippled itself just slightly. So we're just going to have to see how the market reacts here. If it does give us a higher trough, higher peak, well, then the market is suggesting that the discounting to the downside was overdone. It's now time to be looking for some value. If that is the case, we want to get the RSI above 50, and we get the stochastic up above 80, because that effectively pushes the momentum up. Okay, that's what we'll be looking for. How is it at the moment? At the moment, it's actually the weekly picture. So what we saw there is what could happen. What is happening is something like this: 1, 2, 2, 3. Okay, and it looks to me as if that we're in this leg over here. So even though there was some sort of bullishness that came out, I'm not sure how sustainable that bullish is, given the fact that we're actually looking as if we're in a leg down. And if we're in a leg down, well, these rallies are suspect. And if the rallies are suspect, then we've got to look for opportunities to see if we can exploit, okay, those rallies. So what we do is we go through to our daily chart, and what we want to do here is we want to, sorry, the wrong thing. Let me just put the Bollinger back. Okay, apologies. So what we want to do is we want to watch, can the DAX stay in zone 1? Can it stay in zone? Because if it stays in zone 1, then we may be getting the higher trough here. However, if it slips back into neutral and then slips into a zone 3, maybe we're getting this to play out. Now, there's two very different scenarios playing out here. Because number one, if we stay in zone 1, okay, and we get an expansion in zone 1, because we've got a squeeze here, then we get the higher trough playing out. If it drops into zone 3 and we get the expansion in zone 3, then we get the continuation down. So I'm a little on the wall, on the fence for this one. Clearly we've moved into zone 1, but today's action at the moment looks, you know, I need to see a longer candle here. I need to see the market buying into this story that this is going to be a trough. Now, if we get some sort of movement up into zone 1, keep an eye on your greenback as well. It could be money. We had a whole conversation yesterday about where is money going, and we said potentially into cash instruments. Well, there could be money rotating out of the cash instruments. This could be coming back into some sort of normal area. That could be supporting DAX, but it just could be a dip in the uptrend. So if the dollar dips, okay, and then rallies, then we could kind of look for the DAX to see if the DAX bounces and then falls. So there is whole lot of intermarket relationships that we have to keep an eye on here. Let's take a look at gold as well. Because gold is got the US dollar as its denominator, one would think it's moving, right? One would think it's moving. Okay, so yesterday we pointed out we've got the lower peak, lower trough. Take a look at the daily. All right, it's moving. It's still quite weak, So just keep an eye that perhaps the dollar story still has a few paragraphs left. Okay, and let's also take a look, of course, at Bitcoin. Bitcoin was moving yesterday. I did see Bitcoin moving quite strongly yesterday. However, again, take a look where we are here. We're in zone 2. So we're in zone 2 Bitcoin. We're in zone 3 gold. We're in zone 2 dollar. So those are all kind of neutralish with perhaps maybe a slight sort of a dollar edge. And then we go back to our risk market. Our risk market has got an extremely thin volatility to it. I'm not sure that the risk participants have bought into anything at the moment. So what does this all mean? Huge uncertainty, which has been the story of 2022, and we're still stuck in the midst of that uncertainty. Anna's writing out, there's still so much uncertainty caused by the Ukraine war. What if Russia turns off Germany's tap? Well, that of course there's a huge variable around this geopolitical increase. The European Union is also looking to embargo Russian oil within 6 months, so that Russia might retaliate and say, well, why wait 6 months? We'll turn off your oil right now. So I don't know. The whole thing here is very, very much an analysis of very uncertain variables. That's where we are right now. And the Fed, in my mind, the Fed has just added to that uncertainty. It's flummoxed the market. The market's trying to buy into the Fed story. I'm not sure that it has. I'm feeling a bit a little bit sort of rushed by it, you know. So that's the analysis. Uncertainty. Sorry that we didn't get more definitive type of monetary policy commentary from the Fed last evening. Germany's fast-tracking LPG platform, but it will still take years to build, from Anna. All right, I think that's where we'll leave it for this morning. We'll see if there is some sort of clarity that forms in the charts today. Hopefully tomorrow we can have something a little bit more definitive. But before you go, don't go yet. We have got a live trade tomorrow. We've got a live trade tomorrow. So I've just popped the registration link in the chat. That will be the live non-farm payroll. Now, incidentally, the Fed, by becoming more dovish, has now put a whole lot more emphasis on the non-farm payroll, because if there is a very strong non-farm payroll number, then they put themselves bang straight into the corner again. It was a silly comment to make, in my opinion. All right, guys, please join me for tomorrow if you can. Otherwise, we will speak tomorrow morning for the morning market review. Thanks very much, guys.